Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Meta agrees to buy AMD chips and data center gear in a deal worth tens of billions of dollars.
Plus, AI whiplash in markets. It erupts again as investors navigate the disruptive power of agentic tools being unveiled by Anthropic.
And Warner Brothers Discovery is considering a new takeover bid from Paramount Skydance, with its board set to review the proposal and respond.
But first, we check in on these markets that bounced back after yesterday's sell-off. Again, Anthropic front and center. The latest AI tools that have been battering software are now adding some fuel to them. We'll get into that story a little bit later. But at the moment, Nasdaq 100 up by 0.9%. Reprieve, remember, also consumer confidence from a macro perspective coming in better than anticipated. Looking at Bitcoin, though, just nothing better than anticipated with this particular asset. We're currently at 63,993. The pressure's still there, Ed. But what have you got?
Let's get to our top story. Shares of AMD pushing higher. Meta flat, had been slightly softer. At one point in the session, AMD was up about 9% and on track for its best day since November. This is a 6 gigawatt deal. Meta's agreed to buy AMD chips and data center supplies in a deal worth double-digit billions per gigawatt. This is the social media giant looks to prioritize its AI ambitions. Here to break it down, Bloomberg's Ian King on the chip side, Riley Griffin on the Meta side around the table. Ian, I'm going to start with you. The basics of the deal: 6 gigawatts over time, AMD accelerators, but also other gear. It's a big deal for them.
Yeah, it's a real endorsement from one of the biggest buyers of this kind of equipment. Obviously, they're playing catch up with NVIDIA, who had their own deal with Meta last week. So this is a real strong affirmation, and it also includes a share warrants as well that are going to Meta.
Riley, this is all about Meta compute. Talk us through just how large the scale is for demand for this sort of infrastructure right now.
It's insatiable demand from Meta. Mark Zuckerberg last month announced Meta Compute with ambitions to get hundreds of gigawatts to fuel its data centers and ultimately reach that super intelligence goal where AI can outpace human intelligence. And this is just the latest in a frenzy of deals. Again, we're anticipating $135 billion in CapEx this year, but now we know the spending won't stop.
The warrants part is very interesting. It's very similar to what AMD did with OpenAI. There are operational and financial milestones in both directions in order for Meta to potentially become a very big shareholder of AMD. Could you explain that, Ian?
Yeah, I mean, the way to look at it, Lisa Su said, look, this basically ties us closer to Meta. They get these shares if we're in a very good position. I mean, the last tranche, I believe, is about $600. They're, yesterday they closed at less than 200, so we've got a room to go before that becomes a reality. But, her point was that this kind of locks us together and tightens our relationship.
It was really interesting to read through the materials in our reporting, Riley. Like, AMD has played this card before. The emphasis is on inference. So MI450 generation of accelerator, the engineering teams will work together. But the inference part, is there anything unique about this different to what Meta is doing with NVIDIA? Because we had a very similar deal very recently.
It's a really good question. Not only is it similar to what Meta is doing with NVIDIA, but Meta also has its own internal pipeline of custom chips that it's building for AI purposes. What we heard yesterday is that they see different applications, different workloads here being supported by all three of those verticals. And so they're trying to diversify as they pursue this massive scale in terms of compute.
Ian, take us back to NVIDIA, because we've got their earnings coming up tomorrow. And how much does this show that there is anxiety, that companies are diversifying, looking at AMD, looking at their own in-house chips, or actually does it still not a concern? NVIDIA is still dominant?
Yeah, I mean, at this point, all we can do is say, look at the numbers, and the numbers, assuming NVIDIA comes in and executes on what Wall Street thinks it's going to do, the numbers say there's no anxiety here, all boats are floating, everybody's benefiting from the same massive spending in equal measure. I guess what would change that would be if NVIDIA does not hit those targets, does not exceed those targets. That, I think, would change the conversation considerably.
And Riley, the conversation is nuanced when it comes to capital expenditure. Many would say, yes, a lot of it is about the chips, it is about the data centers, but it's also about the power. Can we understand really how much Meta is having to focus in on where they can spend on GPUs or their own homegrown chips, and where they do it globally as well?
So we asked yesterday where they thought they would deploy these chips, and they couldn't specify which data centers. We know that some of their biggest projects are targeting 5 gigawatts, right? But they need to get certain regulatory approvals, and they need energy companies to be able to deliver there on the ground. So as for the merging of the energy and the compute here, time will tell as we home in on where those chips will actually go.
It's probably time for a bit of a reality check-in, and I'm hoping that you'll provide it for us. Like, in any given quarter right now, AMD is going to do $10 billion of revenue, all told, every single segment. NVIDIA's data center business is at more than $50 billion a quarter. Yes, that includes networking, but they're now one and the same, right? You can't have chips without the other. How do we know if this is evidence that AMD is catching up?
I mean, again, you have to go back to the percentages, the growth percentages. At the moment, both of them would say, this isn't about competition. This is about there's so much demand. A company like Meta, which makes its own chips, is buying from both of us. That would be the answer. But ultimately, when the market slows down, and you can be the judge of when that happens, then we'll see the market share shift, because then it'll really matter.
Meta is not a hyperscaler, but it operates its own data centers at hyperscale, if you know what I mean.
Yeah.
I'm thinking back to when Mark Zuckerberg was sat next to the president, $600 billion over the next few years. And then he's also talked about this idea that they might misspend $200 billion here or there, but that's no bad thing. He's front-loading purchases. Just explain his thesis a bit.
Yeah, his strategy is just that. He's used the language of front-loading capacity. They're going to try to get as much as they can, gobble it up while there's still availability. And this, he says, could be applied not just for AI purposes, but for that core social media business, which still drives more than 98% of their revenue, right? So they see applications across the board, and they're not worried about getting too much in the interim.
Ian, why does AMD have to keep giving its shares away?
Again, we asked Lisa about this, and she said that this is Lisa Su, the CEO, and she said this is different than the OpenAI deal. The OpenAI deal is a slightly different arrangement. That is a company, obviously, that is seeking liquidity. Meta clearly does not need liquidity. This is just a way of showing Meta's commitment to what they're doing. You've got to remember that, AMD is only a couple of generations into being any type of presence at all in this market. So if a big buyer of this stuff comes along and says, oh, we like your gear, and oh, guess what, we also like you as a company, like your prospects, then that is somehow a bigger validation than just a straight purchase agreement. And that really was what they were pushing as an idea that, look, this is how closely we are tied together.
Benefiting from the upside, Bloomberg's Ian King and Riley Griffin. Thank you so much for joining us on that roundtable. Meanwhile, coming up, software earnings, they take center stage too. What to expect as AI fears enter the picture. This is Bloomberg Tech.
Shares of IBM had the worst day in more than 25 years Monday after Anthropic announced that its Claude code could help to modernize the dated coding language COBOL, largely run on IBM computers. This as Anthropic continues to unveil new AI tools for its co-work agent software across human resources, investment banking, and design. Bloomberg's Brady Ford joins us with the latest. COBOL was invented in 1959. There are 200 billion lines of COBOL code that underpin financial systems, banking, payments around the world. And basically, Anthropic said it would be really useful to use Claude to help maybe investigate, look into, change that. And then one of the most storied technology companies in history had its worst day in 25 years. Take it from there.
You've got to feel powerful if you're Anthropic right now, right? If you just say the name of a product, the company associated with that project tanks. I mean, IBM has been talking about using AI for COBOL modernization, and it seems successfully offering that tool for a couple of years now. And yet markets are really jumpy, right? I mean, the potential that Claude or another AI tool can disrupt the leaders in a given software category is really frightening investors right now. And it's an incredibly jumpy market.
IBM senior VP Rob Thomas was pushing back against this, writing in a blog, and you quote him in your story, that the value of IBM mainframe has nothing to do with COBOL. He's trying to talk about the platform more broadly, Brody. But what you say is so brilliant, how powerful Anthropic must feel. Also to the upside. Because look, they do a partnership with Intuit today, and that fuels Intuit shares a little bit on the upside. So it can be make or break in either direction.
It fuels into it a bit on the upside, but the company's still down, 40% this year. I don't know if it's quite that dramatic, but it's a scary time to be an application software vendor, right? I mean, the most extreme idea that companies are just going to vibe code their own solutions, I don't think anybody really believes that. But the idea that software vendors lose the kind of pricing leverage they've enjoyed for so long because of that potential disruption, it's really something that markets are struggling to grapple with right now, and it's going to be a really interesting earnings cycle.
It's basically pitching itself now as a platform, right? So historically, Claude is focused on coding and making engineering more efficient. And like, if you're an Intuit customer, you already use all of Intuit's platforms and data. You just have an agent inside of it. If you're a small business or a consumer, it's the same with DocuSign. We're seeing all these names move. How is it making these companies better, Brody? You cover this beat inside and out.
Well, it's forcing them to really try to drive adoption and use among customers. Like, we all know that a lot of the AI hype was a bit premature in terms of how mature these tools were actually and how ready they were to be used in the enterprise. And it's really holding toes to the fire that, hey, it's time to make sure your customers are actually using your AI tools, or else the market's going to sell your stock and act like you all are going to go poof in a couple of years.
Bloomberg's Brody Ford. Always a perfect way with words. We thank you. Let's get more on the wider AI impact on tech and software with ClearBridge Investments Senior Research Analyst for software, for IT services, Hilary Frisch. Hilary, the perfect person. I go back to, in many ways, what Brody was just saying. We're questioning just how good the tools are. Have we seen a sudden shift in how brilliant these AI agents are in the last few months?
We have. We're seeing the sell-off in software, and particularly SaaS, because so much is changing so rapidly, and these tools are evolving tremendously. That said, there's probably a pretty big disparity between some of the capabilities of the tools and what's happening and likely to happen, probably even intermediate term in the marketplace, particularly the enterprise marketplace. But investors shoot first and ask questions at some very distant date. So we're seeing a pretty dramatic compression in terminal multiples of many of the names.
At what point are they going to become discerning? Because at the moment, it's very hard for a CEO, for Arvind Krishna over IBM, for whether it's ServiceNow, Bill McDermott, to disprove that they're not going to be impacted.
That's right.
So how do they prove a negative? How do you start to see people willing to catch a falling knife and be like, oh, these are platform companies, they're not going to be disrupted, or maybe they will be?
Sure. It's so hard to tell the near-term reaction to any kind of event. It's been asymmetrically skewed to the downside. I think what the vendors really have to do is show that AI is additive to the business, to beat and raise, and show that AI isn't just offsetting declines in the core business, but it's actually adding to the business, and that could really change the narrative. We actually saw that with the snowflakes of the world 2 years ago, with MongoDB last year into this year, but that's typically what's required for investors to realize it's not just a zero-sum game.
Mm-hmm.
On the Bloomberg terminal, there are, let's say, a dozen reports of single-name stocks that are moving because of the association with Anthropic, who held an event this morning. You study the software sector, right, very closely. Is there any evidence those names are moving because people genuinely believe there's a fundamental change to how they do business, or is it just simply name association at this point?
I think it has to do with the idea that if Anthropic sees the need to partner with these companies, Anthropic sees that they provide something that Anthropic doesn't, and they understand these are incumbent vendors with installed customer bases and loyalty and processes and things like that. It doesn't mean there isn't future disintermediation risk. We all know that. But I think it's a signal to investors that these companies are viable and important to the ecosystem, and investors have not been assuming that over the prior few weeks.
Hillary, there was a research report, a bearish research report from a little-known outfit called Citrini that basically outlined various risks to different sectors from AI. One of the co-authors joined Bloomberg Television. I just want to play you some of that conversation.
I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months.
In that he's kind of saying, well, this is kind of the function of the market of the last 3 years, but still poses the central question, which is AI rendering existing software obsolete, or is it making it better? Just your reaction to that research report and the co-author's thoughts there.
Sure. I think it's both. I think AI represents a risk, and it also represents an opportunity for many of the incumbent vendors. We could take SaaS separately, but we've been talking internally about what I call the great catch down to SaaS. Every other sector, every other part of software selling down to SaaS on disintermediation risks. But there are reasons why a lot of subsectors should be relatively more defensible. And we could talk about those if you like.
Okay, well, let's talk about what's defensible, because there's this drip feed of AI doomerism, shall we say, in these various reports and blog posts coming from the CEO of Anthropic himself to over at Citrini. We've also had Harvard coming out with their piece that we're seeing it being incredibly effective when it comes to financial analysis and portfolio decision making. The Harvard-led study is talking about how mutual fund trading decisions, 71% it predicted right. The model was trained over a 5-year window, but they're also talking about, look, maybe the outperformance bit is what it misses. So from your perspective, where's the outperformance going to come from some of the companies that can withstand this, that can show that they're really effective while using the AI tools?
Sure. I think of security as an example of that. Anthropic introduced a vulnerability management tool, not even management, just a scanner for vulnerabilities in code that's produced on the platform. And that's a build time phenomenon. Most security vendors are runtime, but they bring a lot to bear that we could talk about from a technological perspective, that it's going to be hard for an LLM or an agent to have. They have the physical infrastructure. They cover all the enforcement points. It's partly a physical phenomenon, not just a digital phenomenon per se. But on top of that, when you think about it, I don't know how entities, and especially regulated entities, can have the fox guarding the hen house when it comes to security. And kind of the same existed in cloud as well, because AI creates so many vulnerabilities, so many new vulnerabilities that we've never had, that it's a major issue when you're looking to what's becoming the greatest attack surface to be the solution to the problem. Similarly, the data platform vendors are really the platforms for the next generation of AI applications. We're seeing them build on top of the Snowflakes, the MongoDBs, even potentially the Oracles, to some degree Datadog. That's slightly different, but what customers are looking for is higher levels of automation to make their lives easier when there's a tsunami of data coming at them. These infrastructures oftentimes are quite different. The data models are different from LLMs. The infrastructure on which they run are far more efficient than what LLMs do and seem to be able to do. And so I believe the greatest source of automation is going to come from these incumbent vendors. I should have mentioned Databricks, of course, in which ClearBridge has a private investment. And so solving headaches for customers in the face of a ton of complexity is going to be of paramount importance.
Hillary Frisch, ClearBridge Investments. Thank you very much. Now, coming up on the program, Paramount is said to have raised its offer for Warner Brothers. More on the drama to buy one of Hollywood's most storied brands. That's next. This is Bloomberg Tech.
Time now for Talking Tech, and first up, Anthropic has accused DeepSeek, Minimax and Moonshot of distilling its Claude models to bolster their own AI capabilities, adding to concerns in the US about Chinese firms improperly gaining an edge. Representatives for the three firms didn't respond to requests for comment. Sticking with Anthropic, look, sources say the company will let some current and former employees sell their shares at a valuation of about $350 billion, the level reached during a recent fundraise. Anthropic has lined up $5 to $6 billion from outside investors, though the amount and details have not yet been finalized. And Canada, well, it summoned OpenAI executives after it was revealed the company debated, but ultimately didn't refer a ChatGPT user to the police. That person became the sole suspect in one of Canada's worst ever mass shootings. OpenAI banned the user months before the attack, but said it found no credible or imminent threat. Ed.
Okay, let's take a look at shares of Warner Brothers Discovery, Paramount and Netflix and get the latest. Paramount has raised its offer for Warner Brothers from its $30 a share all-cash proposal. That's according to Bloomberg reporting. Now, Warner Brothers Discovery and its board is reviewing that revised proposal. Bloomberg's managing editor for media and entertainment leading the Screen Time team, Lucas Shaw. We actually don't have the specifics, I don't think, yet of how improved this offer is, but it's on the desk of Warner Brothers Discovery, its leaders and its board. Take it from there.
Yeah, I mean, you see both sides taking this more seriously and being quiet. I mean, there's been a kind of a progression with these talks where back when the first bidding war was happening, you had Warner Brothers reviewing offers from Comcast and Netflix and Paramount. It was very quiet, right? People didn't say a lot because everyone thought they were in it. Then Warner Brothers picked Netflix and it got really loud. Paramount accusing Warner Brothers of doing things that weren't right. Netflix and Warner Brothers often firing back. And now it's gone quiet again, which to me is clearly a sign that the board is seriously reviewing the Paramount offer. If Paramount has increased it by $1 or $2 a share, which we assume they have, it seems hard to believe that they would outright reject it as they have the recent ones, which means that they would have to go to Netflix and sort of say, what do you got for me?
Well, exactly. And we'll get a drip feed of what it is exactly that they've got. But if it is markedly better, do we expect Netflix to respond in kind?
You know, it's a tough question to answer. Netflix has communicated to some of its shareholders. I've heard from people at Netflix that they feel they have the balance sheet to go up, right? We're talking about a growing business with a really significant market cap, even if the stock's taken a little bit of a beating during these negotiations. So relative to Paramount and even relative to the Ellison family, Netflix should have the money to go there. It's a question of whether they want to. You know, their stock is down. I've lost track at this point. It's more than 30% since these negotiations started. And they may decide that there's a number that is too high for them. We just don't know what that threshold is.
It continues to evolve, and we know that you'll always have the story, Bloomberg's Lucas Shaw. Thank you so much. Now, coming up, more on Meta and AMD's multi-billion-dollar deal as the race to power AI intensifies. And AMD up 7%, coming off of those previous highs.
Yep, and then Meta flat as a pancake. Much more to come. It is halftime. This is Bloomberg Tech. Welcome back to Bloomberg Tech. We're continuing to track the impact of AI on legacy software, essentially. Lots of names actually moving to the upside. The story is at Anthropic and basically taking its Claude AI agent and linking it in a platform for everything from HR, investment banking, documents, and that is pushing a lot of names higher. IBM is up 4%, but remember yesterday, Monday, it fell by the most since 2000 when it said that Claude could be used basically to improve archive, change, update COBOL coding bases, a program that was invented in 1959. Otherwise, our top story is a deal between AMD and Meta. 6 gigawatts of capacity over the balance of the decade, largely focused in the first instance on AMD's latest accelerator and the server that it's based on, MI450. But this is basically $60 billion of potential revenue for AMD over that time period. The stock up more than 7%. Meta is traded flat, but I guess that it's hard to gauge if this makes any difference to Meta at all, given its existing spending commitments? Kara?
Well, someone's been writing on just that, Ed. Bloomberg Intelligence senior analyst Mandeep Singh says that Meta's 6 gigawatt AMD deal actually lowers chip spending as a share of capex and secures supply tailored to AI inference. He also writes that the stock-linked structure could give Meta added leverage against NVIDIA. Mandeep Singh joins us now. Why does it need leverage against NVIDIA? It struck a deal last week with them. Is this more like, we've got other options?
Yeah, and look, I mean, the fact that they are planning to use NVIDIA's CPUs, to me, that was a sign that, you know, if you had to get the GPU capacity from NVIDIA, you pretty much had to use everything they had to offer. With this deal, I think AMD sort of comes across as the more a desperate partner in terms of, you know, giving Meta their stock warrants and making sure that, you know, they are at Meta, which is going to spend $135 billion. Out of that, half of that will be on chips approximately. So think of it this way. They currently are about a $10 to $12 billion run rate. This could potentially double, you know, every year in terms of just by adding one customer at the scale that, you know, they plan to buy the chips from AMD.
You know, the way that AMD puts it, right, double-digit billions of dollars per gigawatt, but the gigawatts need to get built, right? There are operational milestones. Every time I go and see AMD or we speak to Lisa Su, she puts a lot of emphasis on inference. You know, MI450 in particular, and what those systems can do in the inference phase. Do you, in this deal, see a point of differentiation for AMD if they do go after the inference piece?
I do, and simply because all these companies are trying to emulate what Google has been doing with TPUs. And remember, TPUs are used for both training and inferencing, not just for Gemini, but also for Anthropic. So the fact that, you know, they have signed this deal and are willing to, you know, go from being a merchant silicon provider to a custom silicon provider for Meta, and Meta's workloads are more skewed towards, you know, video and, you know, the family of apps they have, similar to Alphabet. To me, this is a sign that's what Meta feels they can accomplish, you know, with the AMD chips. Yes, they will continue to use NVIDIA for training, but for inferencing, Meta's workloads are different from, you know, any other provider when it comes to the chatbots or anything else that they're doing.
You know, AMD was at pains to point out they'll kind of co-engineer the roadmap to future server design, starting MI450 and then go beyond that. Mandeep Singh of Bloomberg Intelligence with the React. Thank you so much. Now, coming up on the program, Rainer Pope from MattX joins us to discuss his chip startup's latest fundraise as it aims to take on NVIDIA. That's coming up next. This is Bloomberg Tech. AI startup MattX has raised more than $500 million to build hardware to compete with NVIDIA. The chip company was founded by two alumni of Google's semiconductor business, and its aim is to make a product specifically designed to run large language models. Co-founder and CEO Rainer Pope joins us now. I think we should get into the specifics, but my goodness, $500 million is quite a large Series B. What do you need that level of capital for, and what does it reflect?
Yeah, so I mean, I would say, very happy to be here, and thank you. One of the really what it reflects is, on the one hand, very strong confidence from some of our lead investors in the product. This is from Jane Street and Situational Awareness have led our round. Very strong on Jane Street's sides. They're absolute technical experts. They understand the kind of product we're doing. And then Situational Awareness, that's Leopold Aschenbrenner's fund. He wrote the book on AGI, and he really understands where this whole space is going. What we are looking to do with this product and with this money. Firstly, I would say the demand for LLM compute is just insatiable. Right. All of the frontier labs are looking at where this space is going, and they're all concerned, I'm going to run out of silicon, I won't be able to serve all the demand I've got. Right. So our goal overall has been to make the highest throughput per square millimeter of silicon that any product has.
This is about computational density.
That's right.
And so you guys are basically saying throughput in terms of flops per millimeter squared, this is something you can own. What was the breakthrough? You know, what is it that you're you're so good at to achieve this?
Yeah, so there's really a combination of two things. If you look at the products in the market previously, there's been the HBM-based family, which is NVIDIA, Google, Amazon, and then there's been the SRAM-based family.
And you are SRAM?
We are both, actually, uniquely. So it's kind of taking two good ideas and putting them together. It is possible to do both very high throughput, as you get from HBM, but also very low latency, as you get from SRAM, and do that in the same product. What it gives you is actually a product that is better than any other product in the market at throughput. This is exactly the flops per square millimeter that you described, while also matching some of the best, like the Cerebras and the Grok, at latency.
Let's talk about how quickly people can start deploying this, Rainer, because what your aim is to complete the final design this year. You hope to start manufacturing, shipping even in 2027. Who do you need to partner with on that? How do you expect to be manufacturing here in the US or abroad?
Yeah, so I mean, there's a few big parts of the supply chain, and this is common for us as well as many other semiconductor firms in this space. Really, you need logic wafers, memory wafers, which is HBM, and then you need rack build-outs. And so those are the big parts of our supply chain. TSMC is well recognized as the best provider of logic wafers, and then the memory wafers, there's the big three, which are SK Hynix, Samsung, and Micron, and then there's a whole range of providers across the rack and manufacturing side. One of the big things that if you want to manufacture in very large volumes, we hear about these multi-gigawatt deals that are coming out. These require billions of dollars of manufacturing, and then actually setting up like hundreds of millions of dollars put into setting up supply chains in advance of delivering that. And so that's a big part of what we're excited to be able to do now. You
left Google in 2022. And the goal was creating a better chip from scratch, Rainer. But have you been impressed by the leaps that TPU has taken? It seems to have impressed the market. What is it that you felt wasn't at Google for you that you now can build better?
Yeah, so I think what is really required is if you want to absolutely nail the LLM workload, you have to be willing to break compatibility with previous chips. And so one of the strong guarantees you see all of the existing players providing is you can take a program that was written on my previous generation chip or my generation of chips 5 years ago, and it will run on my next generation chip. And so a lot of what that means is there are constraints on my chip has to support all of the previous number formats I supported. It has to support all of the different programming model, the way I communicate between cores on the chip. All of those have to be the same as each other. We felt that it would be necessary, like if you really want to just absolutely nail this workload without regards for backwards compatibility or other workloads or anything like that, you need to something of a blank slate design is required. For us, this means very large matrices, very low precision support, and then in fact an ability to split your very large systolic array into small pieces.
You name-checked Grok, I think, with some admiration a second ago. I mean, like when NVIDIA acquired Grok, Jensen Huang's view was that they were struggling to find their place in the world, in the market. And for what it's worth, Cerebras, you name-checked as well, filed confidentially for IPO yesterday. Why might you succeed where Grok had to go to NVIDIA, and I guess they're working on something, and the public markets, are needed for capital going forward?
Yeah, so I would say this is historically, the market has been won by the HBM-based players. That's the Google, Amazon, NVIDIA, and not by Grok and Cerebras. SRAM-only chips are very good for latency, but when you want to run very long context models, you run out of memory capacity. SRAM is too small. Right. It's fast, but too small. Really, the hybrid of doing weights in SRAM, so you get the low latency, as well as having the HBM for very long context support is, we believe that's what enables the low latency without all of the compromises that you would get otherwise.
Rainer Pope, thank you so much for joining us today, MattX CEO.
Thank you.
Look, we're going to stick with funding news. Basis, a startup making AI tools for accounting, has raised $100 million at an over $1 billion valuation. This, of course, as investors grow pretty wary of disruption from agentic AI. Here with us is Matt Hart, Basis CEO. I go to the point. How is Basis different from Anthropic's co-work plugin for an accounting business?
Yeah, well, first of all, great to be here, and thanks for having me, Caroline. Look, we have an excellent relationship with OpenAI and with Anthropic, and I think Cowork, ChatGPT, the whole range of tools that they have are absolutely fantastic. I think, though, you can only sort of serve so many masters. And when it comes to domain-specific work, specifically in our situation, accounting, there's a need to build with that domain specificity in mind. I think it comes down to a couple things. First of all, you want domain-specific capabilities. So, for instance, we announced today the first example of a long-running agent completing an entire business tax return workbook. That's something that you can't really do in any other AI tool that exists out there. You need domain-specific accuracy. So we are able to guarantee to the firms that we work with that the AI will meet the requisite level of accuracy for it to be used in a real manner, and we can sort of guarantee that performance. You need domain-specific user experience so that it's fluid and it works well for people who are experts in their field as they go about doing their work. You can't just have a chatbot or the variety of other sort of basic user experiences that you need. You need to build enterprise sort of grade features, collaboration, audit trails, auditability, et cetera, things of this nature. And finally, you need domain-specific deployment approaches. It's going to, the capacity of a lot of these AI tools to be extremely useful in workflows probably far exceeds the adoption today. And there's going to be a great challenge over the next decade of figuring out how to get AI into all the places it needs to get into. And so we think for all those reasons, being domain-specific is very important. I think that's pretty evident to this day.
And so is that 100 million to ensure the adoption curve is where you need it to be? Where does that money get deployed first and foremost?
Yeah, it's a combination of things. I think for us, first and foremost, we're always focused on building the most capable and the most accurate AI for accounting. So we are growing our engineering and ML teams dramatically. We're a fully New York-based company, and we essentially want to be the home for applied AI work in New York City. So that's always number one priority. But the other aspect of it is we are now starting to serve accounting firms across all of their practices, CAS and core accounting being the initial segment, but now also tax, audit, broader advisory, and over time, figuring out how we can get AI into all these various places is extremely important. Demand has exceeded our capacity to serve it, and so we felt it was important to bring on additional capital to make that possible.
So Matt, I'm going through my taxes right now, and through the portal of my accountant, who I won't name, they do a good job. I upload all of the documents, W-2, 1099, 1098, whatever. But there is an element of observability because I still have to go in and double check all of the automated part of it. I know that's not the same, but the case study you gave of a business tax filing start to finish, the observability piece must be critical if you're handling that for businesses of scale.
Yeah, absolutely. Good question. We think that the ability for an accountant to understand what's happening at a granular level as the AI is helping them get work done is extremely important. That goes back to a little bit about what Caroline was referring to in terms of the, what makes us different than generic tools. Having domain-specific user experiences and domain-specific auditability functionality is extremely important. And then we also think that accounting firms have a very important role to play. At the end of the day, what people like yourself and what businesses around America probably want is a human that they have a relationship with, that they trust to do this incredibly important work. And so having the AI collaborate with humans to make that possible in an even better fashion maybe will improve the experience that you have on your taxes in future years as firms figure out how to bring these two things together is extremely important.
So here the central question is it an aid to an existing job, or does it displace an existing role in accounting going forward? We just have 30 seconds.
Sure, not a 30-second question, but I'll give you my best answer on it.
Sure.
I think, if you look at what's happened with software engineering over the course of the last year, and you can look at this internal to basis, pretty much today, no engineer at the company should be writing any meaningful amount of code. And yet our engineering team, our machine learning team is as busy as it's ever been. We're hiring as aggressively as we possibly can be in those areas. And that's because there's so much additional engineering work that we want to be able to do that when you free up time to focus on more things, you can do more ambitious things. You can build things you never thought you never thought you'd be able to do. And the same thing's true for accounting. There's tons of accounting work in the world that doesn't get done today. The Pentagon just failed its 8th consecutive audit. Companies are misstating financials because they don't have enough accounting resources. Beyond that, the accounting, if you go to any hospital system in America, they can't tell you how much it costs them to provide a simple procedure like a knee surgery. These are all things that accounting can make possible. It is sort of the fundamental way that we understand economic activity that goes on in and around our organizations. And so we think there's a huge opportunity to do more accounting work. Most accounting firms see that opportunity as well and need the capacity to be able to do that. And so from our perspective, this is going to allow firms and the accountants at those firms to take on even more work and get more things done in the same way that sort of software engineering has been able to take off over the course of the last 12 months.
Matthew Harp, CEO and co-founder of Basis. That was a pretty good summary, actually. A little more than 30 seconds, but we'll give you it. Thank you very much. Now, coming up, we've got to look forward to what to expect from President Trump's State of the Union address, which is later tonight. We have the preview. This is Bloomberg Tech. All eyes are on President Trump's State of the Union speech tonight. This only days after the Supreme Court decided to strike down his tariff policies. Bloomberg TV's Washington correspondent Tyler Kendall joins us. What do we need to expect?
Yeah, hey, Ed. Well, President Trump is expected to tout his economic policies that are already enacted, but also push ahead some policy proposals that he would like to see enacted related to affordability, as the White House really plays defense on the issue, according to recent polling. In fact, the Wall Street Journal is now reporting that President Trump is set to announce a negotiated commitment from big tech companies to pay more when it comes to electricity costs related to AI data centers in a bid to remove some of that burden from U.S. consumers. I was here at the White House just last month speaking to the U.S. Energy Secretary Christopher Wright as the administration urged the nation's largest power grid to hold an emergency power auction specifically for these big tech companies. So perhaps we'll get some firmer details on that tonight, because as you well know, this has been a White House trying to thread the needle between bolstering artificial intelligence, but also trying to quell some of those concerns from Americans when it comes to jobs and, of course, the cost of living related to electricity, because that is going to be the number one issue as we head into the midterms. And a new poll out this week from Ipsos finds that 57% of U.S. adults disapprove of the president's handling of the economy. Front and centered, as you mentioned, is going to be that tariff policy. And sitting there in front of the president tonight is going to be those Supreme Court justices that struck down those IEEPA tariffs last week.
Bloomberg's Tyler Kendall with the rundown. Thank you very much. And look, the State of the Union is also the target for bets on prediction markets, like Kalshi, like poly markets. Look, a market that was once a fringe obsession of economists and election wonks. Now, traders are wagering on just about everything. Critics call it unregulated gambling, and it's today's Big Take Deep Dive. I'm pleased to say Bloomberg contributor Chris Beam is here to talk us through it. It is a wonderful deep dive. And just as we think about the State of the Union, how has the idea of regulating this changed in the years?
So currently, the status quo is that prediction markets are regulated by the CFTC. And the reason is that they technically offer what are called event contracts, and event contracts are derivatives. And so the CFTC argues that falls under their purview. Now, there's a lot of people who disagree with the CFTC, state gambling regulators, a lot of casinos and other members of the gambling industry argue, yes, that prediction markets should actually count as gambling and therefore be regulated by the states.
How good are prediction markets at predicting the future?
So it depends what kind of market you're talking about. A lot of scholars have looked at political markets and prediction markets to predict elections, and have overall found that prediction markets are more accurate than polling, and certainly more accurate than you or me or any individual trying to prognosticate about elections. What's interesting, though, is that those markets become less accurate the smaller they are. So, a presidential election market could be quite accurate, but then once you get down to more, state and local races, when there's less liquidity, that's going to be less accurate.
I mean, some of the bets that we see are extraordinary. I mean, I don't know how much liquidity there is on whether Jesus Christ is going to return in the next couple of years, but that's literally something you can go and place a wager, or at least a prediction on, using these markets. How have the companies themselves, Kalshi and Polymarket, navigated what has been them thrust into really now success, but also backlash at the same time, and worries about insider trading in this?
Yeah, the companies have taken different approaches. Kalshi has really tried to position itself as the adult in the room. They emphasize the internal rules that they have around insider trading, around market manipulation. They have whole teams and software algorithms designed to detect trading patterns that might set off red flags, which they then report to regulators. Polymarket is in a slightly different position because so much of their trading happens overseas and is not regulated by the CFTC. And they also just haven't talked about it as much. So I'd say Kalshi, particularly because it was the earlier entrant in the US, has emphasized cooperating with regulators, trying to be above board about the markets that they provide.
It's the latest Bloomberg Big Take, and it's a must-read. Bloomberg contributor Chris Beam, thank you very much. That does it for this edition of Bloomberg Tech. It's not as if there's a shortage of things to come this week. State of the Union and then NVIDIA on Wednesday.
Oh, and earnings after the bell today as well. Look, just don't forget to check out our podcast. You can find it on the terminal, as well as online on Apple or Spotify, on iHeart. The tech news keeps coming, as does the disruption. This is Bloomberg Tech.